Hey everybody, welcome to the video. Thank you so much for joining us. My name is Kirk with Tactical Options Trading, and if you haven't been here before, we make videos about the stock market and options trading. Today we're talking about the iron butterfly. Let's go ahead and get started. All right, we are talking about the iron butterfly. Now, the iron butterfly is a neutral options trading strategy, and I really like trading the iron butterfly. And if you've ever wondered what an iron butterfly is, why you'd ever want to trade an iron butterfly, what kind of market conditions an iron butterfly would be good for, or basically just the overall mechanics of like finding your break-even points and things like that, this video is for you. We're going to talk about all those things here in this video. Now, one thing that I'm always amazed is the names of these different strategies. Now, the iron butterfly is no exception. So you talk about iron butterfly. Where do these things get their names? Where do these strategies get their names? Well, the iron butterfly is from the family of option strategies known as wing spreads. Why? Well, the wing spread family of option strategies gets its name because the strategies in the family are named after flying creatures. So such names as butterfly, iron butterfly, condor, iron condor, these are all strategies that fall in that wing spread strategies category. So, when we're talking about spreads, leaving aside the iron condors and the iron butterflies and things like that, when we're talking about spreads, because that's what an iron butterfly is, it is a spread. There are really only two kinds of spreads. There's credit spreads and debit spreads. Now, you already know the difference, I'm sure, but the debit spread is, when we buy that trade, when we're entering into that trade, we're going to be buying into that trade. So money is going to be debited out of our account. In other words, when we open this trade, we're going to be taking money out of our account to purchase this trade. Now, when we're talking about a credit spread, we receive a credit to enter the trade. So in other words, when we sell to open that trade, we're going to receive a credit in our account to open up that trade. So the iron butterfly is a credit spread, as I mentioned. Let's break it down, you guys. The iron butterfly strategy is created by selling a put credit spread and simultaneously selling a call credit spread in the same option expiration. Now, when we talk about a put credit spread, some people refer to that as a bull put spread. And then we're talking about a call credit spread. Some people refer to that as a bear call spread. But either way, whatever way you call it, we're going to be selling a credit spread on the call side and selling a credit spread on the put side. So basically, when we're talking about an iron butterfly, those two short strikes that we're selling on the call side and the put side, they're going to share the same strike price, and that forms the body. And then we're going to go out and buy a protective call and a protective put, and that's going to make up the wings by doing that. So very narrow body, being an iron butterfly, very narrow body, we're going to go out and buy some protective calls and puts, and that's going to be the wings. So you might be familiar with just a butterfly, which is a debit type trade. When we're talking about an iron butterfly, though, we're going to be receiving a credit, and that butterfly requires 4 contracts to make up this strategy when we're talking about an iron butterfly. So let's go ahead and take a look here. Let's look at XLE. XLE is, we're looking at this options chain of XLE. And you can see that we're trading right now at $65.78. So the closest at the money option would be this $66 strike right here. So the $66 strike, we'd want to, if we're selling an iron butterfly, we're going to be selling the 66 call and then also selling the 66 put. And that's going to be the first half of our iron butterfly trade. Now we need to go out and buy some protection. So we're going to come out here on the call side and the put side, and we're going to buy some protection about $6 wide out on each side. So on the call side, we're looking at around that $72 strike. And then on the put side, we're up there around that down there around that $60 strike. So we're looking at $6 wide on each side. And that's going to form our other half of our iron butterfly. So we're going to buy both an out of the money call and an out of the money put. Now, all these together, the calls and the puts, basically a call credit spread and a put credit spread, and we're selling them at the money, is going to make up our iron butterfly trade. So you can see that by doing that, selling that 66 call and then also selling that 66 put, and then coming out here and buying a $72 call and then buying a $60 put, you can see that for doing that, we're going to receive a net credit in our account of $2.97. You can see a credit right there. Now, Thinkorswim labels this as an iron condor. It doesn't recognize this as an iron butterfly because it's very similar to the same strategy. The only difference is that we're sharing that same strike price at the call and the put on those sold strikes. So we're going to receive a $2.97 credit for selling this strategy right there. So let's break it down a little bit more. So the iron butterfly is a neutral trading strategy that you can employ when you expect the stock to trade in a range. So if you've ever looked at a profit and loss diagram of an iron condor, if you've seen a profit and loss diagram of an iron condor, it's going to look something similar to this right here. It's going to be more flat along that top part there, and our range of profit is going to be a little bit wider here. It's similar to an iron butterfly, but the iron butterfly, because we're selling those calls and puts at the money, it's going to allow us to receive a little bit more credit for selling that at the money call and put. You can see here's the at the money strike right here, and you can see that our profit and loss diagram right over here on this left side, you can see that as we sold that at the money call and put, we were able to receive a little bit more credit for selling right at the money. Now looking at the iron condor down here in this range, these were sold out of the money, so you weren't able to receive as much credit for selling those out of the money calls and puts. So right here in this window is going to be our area of profit on our profit and loss diagram for the iron butterfly. We want to stay within this area here. Now you can see that if you're familiar with a call credit spread or a put credit spread, really looking at this diagram, it's very similar. So we're looking at the call credit spread right here, and then we're looking at the put credit spread right here, and we're just adding those two together, which form that iron butterfly. So looking at it in the Analyze tab in the Thinkorswim trading platform, here it is again. It's basically the same diagram, right? Now we're just actually looking at it on the actual trade that we were just talking about earlier. So looking at that 66 call and put that we sold at the money, you can see that 66 call and put is right there. We received the maximum amount of credit right there. Here's our zero line right here. And so, as if the stock were to be at this point at expiration, we would get to keep all $297 at expiration. And as the stock moves lower, at some point it's going to hit our protective put, and that protective put is going to cap our losses to the downside. Our protective call is going to cap our losses to the upside. And by buying those protective calls and puts, it allows us to not carry as much margin in our account as well, because we have defined risk. So in these types of trades, when we're talking about an iron butterfly is best employed when volatility is high. So volatility is our friend when we enter this trade, but volatility is not our friend after we enter this trade. We want volatility to drop after we enter this trade. So we want high IV when we enter. However, once we enter that trade, we want the implied volatility to start to drop. But increasing implied volatility will negatively impact our trade. So time decay. When we're selling options, time is on our side. When we're buying options, time is against us. But when we're selling options, this is why I like selling options so much, is that time is on our side. So the passage of time will also help our position, as we're net sellers of premium. And remember, as time passes, the value of the options will also decrease. So remember, when we sold this trade, we want to buy it back, and we want to buy it back at a lower price. So as time goes on, the value of all those options is going to start to decrease, and hopefully we'll be able to buy that back at some point at a lower price than what we sold it for. So time is on our side. So the maximum potential profit on this trade would only be the net credit that you received when you entered or sold to open that trade. However, we're not usually going to hold it all the way to expiration. We're usually going to take these trades off early as we start to see that implied volatility start to drop off. Using the example again in XLE, we received a $2.97 credit for opening this trade. So this $2.97 will be the maximum potential profit that we can make on this trade. And you can see again, here's that $2.97 right here, and that would be the maximum amount of profit that we could make on this trade. And we would only make that if the stock were right here at $66 at expiration. If it was anywhere along this line here, between this point here, which is our break-even points, if it's anywhere in this range right here, then we will have a profit at that point. But we'll only make max profit if that stock is at $66 at expiration. So risk is defined in this trade by the width of the strikes less the credit received. So what do I mean by that? So again, remember, we had about a $6 wide spread on each side. We sold those $66 calls and puts. Went down $6 on the put side, went up $6 on the call side there. So got about a $6 wide spread, but we received a $2.97 credit. So to figure out our maximum risk in this would take that $6 spread. Remember, it's only $6 on each side, right? We're not taking the whole $12 there. We're just saying $6 on each side because the stock can't be in two places at one time. So we're only looking at that $6 wide spread, and then we received a $2.97 credit. So we've already received that $2.97 in our account. So to find out what the risk is, or the maximum amount that we could lose in this trade, would be $3.03. So we're risking $303 to make $297. So about a 50-50 chance there on this trade. But it's actually probably a little bit better when you're talking about the expected move and things like that, which is, in another video, it's a whole nother topic we can talk about when you're talking about expected move and how to place these trades around that expected move. So with an iron butterfly, just as with an iron condor, we have two break-even points because the stock cannot be in two places at the same time. We have two break-even points. So to find the break-even points, we take the at-the-money strike price, and then we add the amount of the credit that we received to the call side, and we subtract the amount of the credit received from the put side. So let's talk about the call side here. So again, we're looking at that $66 at-the-money strike that we sold, and we received a $2.97 credit. So we're going to add that to the call side, and our break-even point on the upside is going to be $68.97. So if the stock were to move above $68.97 and it were beyond that point at expiration, that's our break-even point. Anything beyond that would be a loss at that point. Of course, our losses are capped though at that $303 or $3.03 because of the difference of that spread minus the credit that we received, right? So now we're looking at the put side. To find the break even on the put side, you just basically take the $66 at the money strike minus the $2.97 credit, and our break even point on the call side is going to be, or I'm sorry, on the put side, that should say put right there, not call. On the put side, that should be $63.03. So again, looking at the Analyze tab here, you could see that here's our break-even points right here, and you could see that, oops, I got that kind of wrong tool there. You can see our break-even points right here. Here's our at the money 66, and then $2, basically $2.97 on each side of that 66 is our break-even point. Well, what does that look like on a chart? Let's look at it on a chart here. So if the stock we're trading right here is $66, and we put our break-even points on the chart represented by these blue lines right here, at expiration, which is right here at this point, right here. This line represents expiration. We just need this stock to be inside these blue lines at expiration. So, you know, if we're trading up here and it actually comes out above and back in, we're okay with that. You know, comes down here and, you know, maybe comes back in here, and best case scenario pins right there at 66. That's really good for us. So, you know, again, we're usually not holding these trades all the way to expiration. We're holding them to about, you know, 25% of max profit, somewhere in there. So really, we're just looking for this stock to trade in a range and be in that range around expiration. So this is why I really like these iron butterfly trades. And when you can place these trades on when implied volatility is really high, you can receive a lot more credit, which is going to move your break-even points out even further, because, you know, we take that at the money strike and we add or subtract that credit that we receive to find these break-even points. So it stands to reason that the more money that you receive when you open up this trade, it's going to move these break-even points out even further. So we like to sell these when option pricing is high, and that would mean that implied volatility is high, and then we're waiting for that implied volatility to start to shrink, which decreases option pricing. All right, so let's take a look at some charts here and to get an idea of what we're talking about when we're placing these trades. So I like to place these trades after the stock has had a big move, or it's kind of coming into some form of support or resistance. So in this case, we're looking at Lulu, and you can see down here I've got the implied volatility percentile, or the IV ranking right here. And you can see that we're about middle of the road. We're not the highest we've been, and we're not the lowest we've been. We're about middle of the road. In this case, we're about 50% on the IV percentile. And we've had some, you know, a little bit of a retracement here. So we've come down in here, and now looking at these Fibonacci levels, we've retraced. And in some cases, we're right up against that 1272 extension and that 1618 extension. And then we're also coming up against that 786 retracement level. You can see that we've kind of bounced in here about that 786, and we're starting to form a little bit of a resistance. And, you know, usually once a stock breaks through, sometimes it's going to come back and retest it. So I like to, you know, form these trades around places where there's it's had a move and we're coming into some resistance, so it can kind of trade sideways for a while, and that implied volatility can start to decrease as it trades sideways. So you can see here, implied volatility is up. We coming into a range here. So about right in this point would be, you know, good. It could be a good place to place an iron butterfly trade. Again, I'm not recommending Lulu or XLE or anything in this video to trade. I'm just using these as an example, but one good place to look at there. So guys, hopefully this video has been helpful. Thank you so much for watching. Appreciate you guys watching our videos, and if you guys have any comments, anything, any questions about iron butterflies, post them in the comment section below. We'd love to converse with you through you know, through the comment section. Appreciate you guys watching our videos. If you think it's been helpful, give it a thumbs up, and if you haven't already, see this button right here, guys, click it. Click it. We enjoy talking about options, and hopefully you know, hopefully this is some good content for you guys. And you know, never stop learning when you're talking about trading. There's always something new to learn, and we hopefully that we can be part of your learning as you grow in the options trading world. So guys, thanks so much for watching. Appreciate it. Have a good one. We'll catch you on the next one. Bye bye.